Junaid, can you hear me? Junaid, Shoaib Zaman, sir.
Yes, ma'am.
Okay. So I will start, inshallah.
Inshallah. Sure.
رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي نحمده ونصلي على رسول كريم أما بعد. Assalamu alaikum wa rahmatullahi wa barakatuhu to one and all present here. I begin in the name of Allah, the most gracious, the most merciful. Myself, Nusrat Ansari, currently working as assistant professor in one of the reputed engineering college of Mumbai University. Currently, I'm pursuing my PhD in AI and image processing. I'm honored to be part of PSF Women's team. It gives me an immense pleasure to welcome you all to this much awaited and insightful series on Sharia compliance organized by PSF. This three session series is designed to provide a comprehensive understanding of investment practices that is aligned with the principle of Sharia. So today is the first session which will be led by Shoaib Zaman, a certified financial planner. Before we dive into today's powerful content, let us begin with a remembrance of Allah as He beautifully reminds us in Quran, Surah Araf, chapter 7, ayat 204. It says, और जब कुरान की तिलावत की जाए तो उसे गौर से सुनो और चुप रहो ताकि तुम पर रहमत किया जाए. In align with this, I invite Namia Binte Javed. She is second year IT engineering student and she is currently serving as Talim and social media in charge at GIO. Over to you, Namia.
Assalamu alaikum wa rahmatullahi wa barakatuh. The ayat I will be reciting today is Surah Hadid, ayat number 21 22. أعوذ بالله
Namia, you're not audible. Namia, you're not audible.
Am I audible?
Yeah, you're audible.
أعوذ بالله من الشيطان الرجيم.
Namia, again, you're not audible. You're not audible, Namia.
أعوذ بالله من الشيطان الرجيم. بسم الله الرحمن الرحيم. سابقوا إلى مغفرة من ربكم وجنة أرضها كعرض السماء والأرض أعدت للذين آمنوا بالله ورسله ذلك فضل الله يؤتيه من يشاء والله ذو الفضل العظيم. ما أصاب من مصيبة في الأرض ولا في أنفسكم إلا في كتاب من قبل أن نبرأها إن ذلك على الله يسير. Translation: Hasten for the forgiveness of your Lord and paradise, whose expanse is as wide as that of the heavens and the earth, which has been prepared for those who believe in God and his apostles. This is the bounty of God which he bestows on whosoever he pleases, and the bounty of God is infinite. There is no calamity that befalls the earth on your own selves, but in accordance with the law before we make it evident. This is indeed how the God works inevitably. Urdu translation: अपने रब की माफी और उस जन्नत की तरफ एक दूसरे से आगे बढ़ जाओ जिसकी चौड़ाई आसमान व जमीन की वसअत जैसी है, और जो उन लोगों के लिए तैयार की गई है जो अल्लाह पर उसके और उसके पैगंबरों पर ईमान लाए। ये खुदा का करम है जिसे चाहे अता फरमाए, और अल्लाह बड़े फजल का मालिक है। कोई बड़ी मुसीबत ना तो जमीन पर पहुंचती है ना तुम्हारी जिंदगी में, मगर वो उस किताब में उस कबल कि हम उससे पैदा करे होते हैं। बेशक ये अल्लाह पर बहुत ही आसान। जज़ाकल्लाह खैर।
Jazakallah khairan kasira Namia for uplifting our heart with the beautiful words of Quran. Introduction to PSF. Now, I would like to invite Sister Nilufar Ansari. She is a senior SAP consultant with more than 12 years of experience with multinational company. She is also an active member of PSF Networking and Community Building Vertical. She will highlight brief overview of what PSF stands for and what is its vision. Over to you, Sister Nilufar.
Assalamu alaikum rahmatullahi wa barakatuhu. Thank you, Nusrat ma'am, for the introduction.
Walaikum assalam.
Let's have a quick intro on what Professional Solidarity Forum is all about. We are a registered organization with a group of professionals from both IT and non-IT domains. Our primary objective is to provide a platform that can assist the professionals to enhance their skills and creativity for development of self and bring a positive change in the society. PSF Mumbai was established in 2017 with a handful of professionals, and today we have around 400 plus members with us. Our aim is to foster personal growth while simultaneously contributing to the betterment of society. Our structure looks like this. We have city president, city vice president, core team, members, and associates. The roles and responsibilities of city president and vice president is to lead the plan, budget the activities, delegate execution of plan to the concerned members, and provide leadership. The core team conceptualize the activity and own the execution of tasks. Members actively participate and contribute their skill and time and donate as and when required. They are involved in promotion of the event. Associates are the passive participants who are involved in the activities just like the members. The contribution from the city president, vice president, and core team is 500 a month. Members contribute rupees 300 monthly, and associate can voluntarily donate as they wish. We focus on the three broad areas: service to professionals, networking and community building, core social services. We will explore more about them in the next slide. So under service to professionals, we aim to empower individuals by exposing them to emerging technologies and skill sets that can assist them with personal growth and career development. In masterclass, we arrange a 1 to 2 hour monthly session that focus on technical topics. We do have short 2 to 3 month online program to help individuals become job ready. Under mentor-mentee, we have a structured program where an experienced mentor will provide guidance and support to the mentee to overcome the challenges that he or she faces. We had course tie-ups in the past with training institutes. So if any one of you is interested, they can contact the admin and get more information on that. So in networking, we have community engagement, get together, dinner meet. So we arrange session on psychological well-being and financial literacy, leadership and current affairs. They equip individuals to build resilience and improve the quality of their life. We do have a half-yearly get-together, dinner meets and family connect. This involves engaging with members, facilitating interaction and creating opportunities for connection and collaboration. Core social services. We have 2 flagship projects under core social services, Kafalat and Neki Basket. Let's delve deeper into this in the next slide. We firmly believe that every child has the right to education. Project Kafalat aims to help needy students by providing them with education support. In academic year 2024-25, we have sponsored 272 students in Mumbai, Navi Mumbai and suburban areas with an amount of almost 27 lakhs, alhamdulillah. As visible in this slide, alhamdulillah, our progress is trending upward, demonstrating the positive impact of our initiative. Let's look at how does this work. It is a very, very transparent process. We do a strict scrutiny of background of the candidate to get assurity if he or she really deserves to be helped. The donor can select a child from the website, choose the amount to donate, and the amount is directly handed over to the school. We keep a track of the progress of the child, and all the information is shared with the donor as and when required. Moreover, you get a tax benefit of your donations and they are exempted under Section 80G of income tax. Neki basket is a beautiful Turkish concept of Neki ki tokri. This provides a means of combating hunger and malnutrition in the society. Our belief is koi bhuka nahi sona chahiye. So join us in fighting the hunger. Your contribution, no matter the size, can really make a difference in someone's life. We carry out distribution in Jogeshwari East, Ambujwadi, Malad, Malwani. So total packets distributed since inception is 33,000 plus. We serve 10 meals per month. There are approximately 100 packets per meal and 170 plus families are benefited from this initiative. So the process remains the same as Kafalat. You can check our website or app, select the cause and donate online. You get a receipt of the donation, and again, all the donations are exempted under Section 80G of income tax. You may note down the URL and contact number. If anyone is interested to join us or you have any doubt about our organization, you can contact the admin. You can go through the website. The number is flashed on the screen. You can note down the number. This platform is open for students in their final year. It will provide them with immense opportunities to network with experienced professionals and familiarize them with great ideas. So while we come to this concluding slide, Let's take a pause here and understand why do we have to do this. Contributing to the society is the basic moral duty of every individual. And being Muslim, this must be rooted in our principles and values. Thus, I humbly and wholeheartedly request each one of you to come forward and join our platform. Bring in more professionals in your network to collaborate and be part of this activism. Contribute in whatever means you can, your valuable time, money, skill. It will never go in vain, inshallah. Allah Ta'ala will reward us in the world and hereafter. No act of kindness, no matter how small, is ever wasted. This is an opportunity for all of us to grow as a person and better understand how we fit into the world around us. Let's do a cumulative effort to bring a meaningful change by aiming to build a community, a society that is not just affluent and knowledgeable, but a society that is spiritually strong, has a purpose, shows empathy, has a great sense of responsibility, and surrenders to the will of Allah. With this, I conclude and hand over to Nusrat now. Jazakallah khair.
Jazakallah khairan kasira, Sister Nilofer. Yeah, indeed, PSF aims to build strong, spiritually aware, and professionally thriving Muslim community, working towards excellence in both दुनिया and दीन. एक हदीस का मफहूम है जिसमें रसूलुल्लाह सल्लल्लाहु अलैहि वसल्लम फरमाते हैं, लोगों में सबसे बेहतरीन वो है जो लोगों के लिए सबसे ज्यादा फायदेमंद हो. Without further ado, I take a pleasure to introduce the speaker of our first session in this insightful Sharia series, Mr. Shoaib Zaman, a certified financial planner with over 15 years of experience in investing strategies, stock market research, product design, and personal finance, Islamic financial ethics. Brother Shoaib started his career as a journalist where he focused on writing impactful ideas on mutual funds, stock analysis, and financial literacy. Later, he transitioned into the product development of asset management companies, gaining hands on experiences in financial instruments. Currently, he works independently, offering his expertise to corporate, magazine, and financial agencies. We are truly honored to have him with us today. With So with this, I now invite Brother Shoaib Zaman to begin this enlightening session. Over to you, brother.
Jazakallah khair. Thank you so much. Assalamu alaikum, everyone.
Walaikum
Just a second,
assalam.
I'll just share my screen. Everyone can see the screen?
Yes, the screen is visible. Uh, Slideshow, if you can do it, sir.
Yeah. Is it coming as full screen?
Yes, yes.
Okay. Uh, okay. First, Rabbi Shrah li sadri wa yassir li amri wahlul uqdatan min lisani yafqahu qawli. May Allah make it easier for me to speak to all of you and explain uh, our entire session in the right way. So basically, out of the 3 days that we have planned, the first 2 days will be a presentation based explanation, and the third day we'll basically be working through websites and Excel sheet, and I'll be explaining the nitty-gritty of stock picking. My introduction has already been done, and I'll not take up any more time on this. Now, what should you expect from this entire interaction, uh, that I'll be explaining key concept, basics of savings, investment, investing, insurance, and budgeting. Uh, I'll also explain the financial instruments, Sharia and the Sharia compliance about it. We'll also understand why certain instruments are not Sharia compliant. Okay. And we'll learn about the process of investing. What you shouldn't expect is I'm not going to talk about this is the fund where you should invest, this is the stock where you should invest, or this is how you will become rich. Okay. That out of the way, the first 2 days, as I've already said, we'll basically be covering the entire presentation is basically into three portions. First is basic concepts. Then I'll be explaining different types of mutual funds. And then I'll explain about Sharia compliance and how Islam looks at money and what Sharia compliance is and what are the different things. On day three, we'll basically be talking about stock investing and how what are the very basic stuff about stock investing and how idea generation is done. Okay. The flow will be each time I'll explain a topic, then we can ask you guys, please feel free to ask any question that you have, and then I'll proceed to the next topic. Just for the sake of my ease, so that I understand the broad audience, if everyone can just state their profession and what's your specialization like in the main chat. I just put up a broad sample example as to how you can explain about yourself or about your work. That would be great. Are we getting anything in the chat, Junaid? Okay. We have someone who's from teaching profession. Great. Engineer, cloud architecture engineer, design engineer, procurement, IT, software. Okay. Engagement manager, assistant manager, IT, physician. Okay. So most people are investment consultant and founder. Great. Um, okay. ACCA, MBA, marketing. So we have a fairly broad range of people from various field. Okay, that's just. But most of you are from IT, so most of the example I try and keep up with IT, and I hope that I'm going to speak in full English. That wouldn't be a problem, right? So this is a question. This is a basic question. People from financial background need not say, but let's say if you have got 10 lakh rupees and it grows by 10% each year, so how much will it be in 5 years' time? You have only 5 seconds to respond. Anyone? Anyone who wants to give their answer? 15 lakhs. Okay, great. So,
Around 11 lakhs.
so most people will answer 15 lakhs, and I understand it's a very simple thing. Because the way we all think is 10 lakhs on 10 lakh rupees, we are making 10%, which is around 1 lakh rupees. On 5 years, we'll probably make 5 lakh each, and then that's sum totals to 15 lakh. And that is how simple interest, that's a linear thinking process. That's how we all think. That's a natural phenomenon. The actual answer will be it will be 16 lakh 10,510 rupees. Okay. And if you see because we are making this calculation on at a mental level, which is why the difference of that 1 lakh 10,000 rupees or 7.5% gap is something that we will probably ignore, or we will say कि हाँ ठीक है, it was near about, there wasn't much of a difference. But the difference between compound interest or compounding and simple interest is that over time the gap becomes fairly large. So if you just look at the screen, that same that 7% gap in 5 years becomes actually 30% gap in 10 years. In about 20 years time it becomes 124% gap. And that's why compounding is something that we will find very difficult to comprehend. Okay, to make it much more easier for everyone, I am going to show it in a graphical format. So if you see the convexity, because of this is why over a long term people are able to generate a lot of wealth if they remain invested and if they continue investing. Okay, and if you, another way of looking at this would be, let's say if I say that would you be interested in saving 1 crore rupees, or let's say if 1 cr, many people will find it a humongous task. But let's suppose we are able to make an investment which grows at around 10% every year, and we would want to achieve our target of 1 cr in about 10 years time, which effectively means that every month we need to save around 50,000 rupees, 48,400, whatever. So around 50,000 rupees every month. But let's say if we just increase the time frame by about 5 years and everything else remains constant, like the goal is still 1 cr, the rate of return is still 10%, then do we still need, then how much do we need to save on a monthly basis? And here you say, here you can see comes the most interesting part. The moment we are increasing the time frame, the amount required is very small. So over a fairly long period, like 20 years or 30 years, if you see, it's very much a manageable number for most people. Okay, and this is the true power of compounding. One small trivia, uh, I hope everybody knows Warren Buffett and everyone has heard of him at some point or the other. I would really want to make it very engaging session. So if you can also keep up in the chat, that would be great. Okay. Even if, so Warren Buffett is the richest person, or is among the richest person in the world. And if you look at how he grew his wealth, one of the reasons why he's very famous and why everybody looks at him is because throughout his life he was an investor for most part, or at least that's how most people know him. Okay. Uh, but most of his wealth has come after a very long investment career, as in he was investing for about, so he became among the richest person after the age of 60, after the age of 50 or 60 something or 50 something. And the reason why the wealth grew so much was because of the compounding impact, because his base became high enough that each time the compounding happened, the impact was also very high. Okay. uh okay, one important part, how everybody wants their investments to grow, is this orange line that you see on the screen. Okay, we always want it to grow on a linear level. So every year it grows by a certain percentage, and it should keep growing on a regular basis. Now, in reality, what happens is, uh, the growth is never linear. Sometimes it will grow by 1%, sometimes it will degrow, okay, by -4% or -20% or whatever, and then it will again grow by a very sharp level. So what we are expecting is is the orange line. What actually happens in life is this black line that you are seeing. Okay. Uh, w- okay. Three important things that you should know that you can't see my screen. Can everyone see the screen?
Yes.
Okay. Okay. So, Hafiz sir, I think there is some issue. Maybe you should log out and log in again. Yeah, you should try rejoin it because everyone else is able to see the screen. Uh, One of the most among the most common terms that you will keep hearing is compounded annual growth rate and average returns and absolute returns. Why it's important to understand these things? Because in different instrument, people use different information. Like if you will talk to anyone who invests in real estate, they'll always be talking in absolute returns. I had made an investment into this flat or into this plot of land for 10 lakh rupees. And after 5 years, it has become 20 lakh rupees. Or after 10 years, it has become 20 lakh rupees. So what everybody is quoting is absolute returns. It was 10 lakh rupees, it became 20 lakh rupees. If we look into this particular example that we have right now, 1 lakh rupees becomes 2 lakh 72,000 over 10 years time. Okay, this is 172% returns. Now, if we convert it into CAGR, which is compounded annual growth rate, to make it simpler, if we convert it into this orange line of calculation, then it becomes 10.54%, which effectively means every year it was growing by this same amount, by 10.54%. So in 10 years' time, 1 lakh rupees becomes 2 lakh 72,000. What is average returns? Average returns is basically whatever returns took place in each year, it's the average of that number. Since most of you are from, like all of us have already studied this in our basic arithmetic. So you can see average number does not showcase what will be the returns in a particular year, but rather what is the mean of the entire series. Next slide. Now, another important term before we get to the term, the most common thing that like is if we look at petrol prices, many years ago, there was a time when this was around 30 rupees or 35 rupees or so. And today, if you look at it, it's around 100 rupees. So if you look at petrol prices, every year on average, it has been increasing. While in few years, it has also gone down. For example, in 2015 and 2000, maybe 19 and 2009. But in all other years, it was going up. So this increase in price is a realistic thing, is a very real thing. And if you look at it, increase in price, if petrol prices increases, everything else gets hit because there is because it's a very core energy that we are using in our life, and this concept is called inflation. This price increase that we see year on year is what is called as inflation. Now inflation is a very real problem. If today, if I would say that after some time, maybe after a few years, the price of uh, petrol will become 200 rupees, it's not something that we cannot envisage. But for many people, if you just tell them, maybe they may not agree to it. They'll say कि अरे 200 तो जाने का chance is very little. But that's not the case. Prices will e- effectively always increase. So inflation is a very important concept to understand. It's basically increase in price. This is the rate of inflation in India in for the last 10 years. If you look at historical India's inflation for around 25, 30 years of number, it will come to around 5.5%. If you look at for last 10 years, I think it should come around 6%. And but there are phases. So sometimes if you look at broader inflation range, we fix the range between 4% and around 7%. So while extreme cases like in 2013, 12, 13, inflation in India was around 10% on average. Okay. Uh, Now why was inflation important? Inflation was important because inflation adjusted returns is called as real returns. So when someone says what is the real returns, they effectively mean they can mean two things. Most often it basically means whatever your return was minus inflation. Why? Because today if you buy something with 100 rupees and after 1 year that same thing cost you 106, then inflation rate is 6%, right? And inflation rate is 6%. Henceforth, when you go tomorrow to buy that same product, you need to shed out 106%. So if you are making an investment which from 100 rupees becomes 106 rupees, then you are actually not making any returns. Your returns is adjusted to inflation. It's the same as inflation, right? Real wealth increases only when your returns is over and above inflation, which is why real returns is very important to understand. Also, if we look at uh, how the reality of life or the intricacies of life, we see that inflation is not the only thing which is bringing down your returns. The other thing is your taxation. So, just to give you one example, let's say a fixed deposit gives around 7.5% or 7.7% returns, and inflation is 7.59%. Okay. So post taxation, which is around post taxation, real returns for a 20% tax slab guy is actually minus 1.43%. And the real return for someone who is in the tax bracket of 30%, your real returns come down to minus 2.2%. Okay, that's one way of looking. Another a simpler example would be, let's say if let's say someone would invest 100 rupees and they are getting an interest or returns on of 5%. So they basically make 5 rupees. Out of 5 rupees, you give away your tax, which is 1 rupee. So you are left with 104 rupees. So, and if on a 100 rupee investment, you make 104 rupees and inflation is 5%, then 100 rupees, whatever you are buying today for 100, tomorrow you will have to buy it for 105. So your real return is actually minus 1%. Okay. Which is why real returns is extremely important. Uh, Another concept that is quite important to understand is the savings and investment. For many people, savings and investment is the same thing. Okay. In the financial services, or you can say if you ask most of the financial experts, they will say that savings and investments are two different things. The way I would like to explain everyone is savings is whatever is left. Um, Sorry, this is actually income minus expenses. There is a error in the sign. Okay. Then whatever after from your income, whatever you have spent, what is left is your savings. If you put this savings in a way that it generates some extra cash and it adds to your income or it adds to your overall wealth, that is called as investment. Okay. So this line that you see can become investment only if it is able to generate returns. To give you a real life, a very simple example, let's say you buy a house and you start living in it, then that is savings because you don't have to pay rent anymore and you are able to save some amount, right? it is not an investment because you are consuming it. But supposedly, if you decide that you buy a house, you put it on rent, then it becomes an investment because you are earning cash flow from it, or you are earning regular rent from it. Similarly, going towards your house or traveling from office to house or off house to office and back forth, you buy a car. That is your savings. But if you buy a car and you give it to Zoom car, or you give it to a driver and say, okay, drive it in under Uber, then that becomes an investment because you are going to get some cash flow from it. So savings and investment, the basic difference is savings is whatever you are able to save from your income, basically not spend. But savings become investments only when you put your savings in a way where you are able to uh get cash out of it. Okay. So this is a very short example that I'll take you through uh, to explain to explain a business so that we can understand the term equity and debt with ease. Since most of the attendees are from IT, so I'll stick to an IT example. So let's say if we start a software company, or let's say we start a AI company, right? So we have some idea. Our basic business idea is we'll create an IT company which is going to invest, uh, which is going to uh, what will the IT company do? Can someone give me some idea?
It will provide the services.
Okay, let's say we will provide some services. So services is basically what? Uh, providing IT setup to some other company, maybe a manufacturing or some banking, financial services, or whatever, right? So if we set up a business today, then there will be a setup cost that we will incur without even starting a revenue. Matlab, we don't have any revenue stream, and yet we'll have an expense because we'll have to hire people to whom we'll have to pay. It may take us 10-15 days to get a client, or it can take us a little longer. When we hire people, we'll also have to get a space, right? So there is a initial expense itself just to start the business. So how do we bring about the money for this expense? There are only two possible options. One, or you can say three possible options. One, we put our own money. We get ourselves some partner who contributes to the business, or we go and borrow from someone. So when we are putting our own money, that is equity. When we are getting ourselves a partner who is also investing with us, that is also equity. Okay, that is share capital. And whatever we are borrowing from friends, family, you can say taking a loan from the bank or whatever, that is debt. Anything that we are borrowing from someone, it's a debt, and it has to be repaid. Uh, in the Indian context, or let's say globally, current global standard says that when you are borrowing some money, you don't just return the principal amount, but you also give something extra. You have to pay some extra amount. That extra amount is basically your interest. Okay. So all debt, they carry some sort of an interest. And equity, the person who is investing into equity is investing with the clear idea कि ठीक है, there is a probability that the business will work, and there may be a small probability the business may not work and we may just fail, in which case the money goes to zero, whatever people have contributed. So with equity, you share the profit as well as the losses. With debt, you don't share the losses, but you have to return the money in full. On top of it, you also need to pay some extra amount, which is your interest. Okay. Now, once we have set up the business, let's say we are taking uh, we are only taking 20% debt or 10% debt, and 80-90% we are putting our own money, and we set up the business, and we get ourselves some client where we are helping them with their IT services. Okay, we're taking care of it, which starts bringing us income. Now with each month when we are getting those income, we also have some expense because we have to pay everybody's salary, we have to pay for the location, for the office space, we have to reimburse for all the traveling that all the employees did. So after you remove all of these things, whatever you are left with is your operating profit. Okay, your operating profit can also, now an operating profit for one business can be, let's say, uh, 1 lakh rupees, and a similar competitor can have 100 rupees, right? Now whether this 100 rupees guy is more profitable or whether the 1 lakh rupee guy is more profitable, if you look at it uh, from a if you look at it broadly, most people may end up saying that, that 1 lakh rupee is more profitable. But the best way of understanding whether who is more profitable is to basically see what level of income do you have and what is your operating profit. Okay, this is called calculation of margin. How is margin calculated? It's basically operating profit by income. So it will give you some number into 100, and it will give you some number which basically normalizes irrespective of the size of the business. Okay. So once you get to CK, the margin is 20% or 50% or 100%, you know how much of money you are making any which ways. On top of it, will end up paying some taxes. After paying taxes, after giving out the interest, after all of those things, whatever is left is net profit. So that net profit is, let's say, it's invested in the business or it's invested in a way which is generating additional income for us. So what's the idea of understanding this entire thing? The idea of understanding this entire business was to understand two key concepts, which is equity and debt. So going back, equity is basically your portion where people are becoming your partners, and debt is the portion where people are basically lending you some money which you can invest, uh, which you can invest, or you can use it in your business, or you can use it in a way wherein you need to return to them along with some interest. Okay, so far any questions in whatever terms we have discussed? You can feel free to write, or if you want to speak, feel free to unmute yourself and you can just go ahead and ask a question, or otherwise we'll just move ahead to the next topic. Okay, good to go. So Javed bhai has said it's good to go. Great. What is the difference between equity and shares? Equity and shares are the same thing. They There is no difference between them. It's just different term. So similarly, debt and fixed income means the same thing. Equity and shares means also the same thing. No question so far. Okay, great. So now that the concepts are clear, what is it that where can we invest our money? Okay. Uh, we basically have around 5 options, more or less. Okay. One is real estate. We can, whatever money we have, we go buy some real estate, whether be it flat, land, or so on. Okay. The other option is that we do a fixed deposit either with a bank or with a corporate. So corporates also do fixed deposits. For example, you may have heard about uh, NTPC fixed deposit, or uh, PFC fixed deposits, Power Finance Corporation. or fixed deposits by maybe some other corporate. Okay, and those are of a wider range. You will come across some corporate fixed deposit which give you like 10, 12, 15% returns, and then there are fixed deposits which give you probably barely 1% more than whatever the bank FD does for the same period. Okay, the higher the interest rate shows that higher is the risk. Okay, the third option that we have is we buy gold and we keep it. The fourth option we have is we buy shares or equities, whatever. And the fifth option is we buy a mutual fund. So before deciding on which one is the best, we need to understand how each of them actually function. At least historically, they have functioned. For example, real estate, on average, globally, their expected time horizon for giving you your returns is between 10 years and 30 years. Yes, I agree that there may be some cases, someone's uncle, or maybe one of you, or someone you know may have invested in a piece of plot or in a or in a flat, and that money would have just doubled or tripled in about 2 3 years or a very short time frame. But each time that happens, the question is that someone just gave you a number, someone just quoted you a number. If you tried selling it, would they get that much money, and did they sell it and did they get the exact amount? Most often that may not be the case. But if you look at it uh, historically and by all numbers, the returns, real returns or expected returns from real estate is always is mostly at inflation uh, or its great returns as at par with equity, and sometimes it has also been below inflation, the real returns. Okay, uh, one of the ways of understanding this would be, let's say if someone ever comes and tells you, okay, I made an investment into real estate and the money doubled up in 10 years time. So doubling up in 10 years effectively means that your rate of return was around 7.5%, 7.2% per year compounded annual growth rate. How did I come to it? The answer is the rule of 72. The rule of 72 states that if you have the time frame and how much time frame it doubled up, or if you have the rate of return, the CAGR returns, you can calculate the other part, which is if you have the returns, you can calculate how much time it will take to double up, or if you know in what time it doubled up, then you can calculate what was the rate of returns. So a simple example would be, let's say, 72 by 10, because we know that the money doubled up in 10 years time, and that's why we know the rate of return was approximately 7.2. It may be 7% or 7.5% to be exact, but on an approximate back of the envelope calculation is very easy to figure out. So whenever people come and tell you, okay, this was the rate of return I have got, you can just check. In India, generally we believe that real estate returns uh, on average is not very high, except for in few cases where your returns are excellent because luck was on your side, or you managed to do a very good investment. To give you an example how real estate gets impacted, since all of you are in Mumbai, I believe many of you would have also grown over there, right? 15 years ago, the center of Bombay was South Bombay, right? Most of the businesses, corporate houses, their headquarters, their main offices 15, 20 years ago was in the region of it was in South Bombay near Nariman Point or towards Kolaba or somewhere in between these two stations. Today, if you look at it, the center of Bombay has actually moved. Now, if you see, most of the offices or headquarters are either based out of Parel area or they are based out of BKC. Okay. For some, perhaps it may have even moved to Andheri. So now the spread is at three different locations. And similarly, the prices have also moved in the city. So, which is why with real estate, it's very important to understand how the population is moving in a city. If you can predict the flow of the population, maybe you can make great returns from real estate. Am I clear so far? Is there anyone here
Yes.
who is not from Bombay? From Andhra Pradesh. Okay, so Abdullah bhai, sorry, you may not have got it. But roughly, if you look at it in your own city, probably you would be familiar with Hyderabad. Even if you see from Hyderabad, you will find something similar over there. That in certain areas have changed over the last 15, 20 years. Population has moved where earlier the headquarters were. Today it's not there. It has probably moved to some other location, and because of this movement or the flow of population, your real estate prices have changed. So it's not that you don't make losses in real estate. It's also not that you always make profit into real estate or you can always make money above inflation in real estate. In real estate, you can make a lot of money if you can understand how the population is moving and if you can get it right. Now, the second place where you can invest is your fixed deposit. Fixed deposit, I not in my memory. I know that my parents have seen, or maybe your parents would have also seen the time frame where fixed deposits were giving you very high returns of 12-15%, and this was early 90s. But at least in our lifetime, or as much as we would remember, most of us, we'll find that inflation, if you look at it, inflation post taxes, post inflation, the real returns has always been at the negative end, has always been negative or close to negative, which effectively means anyone who puts money in anyone who puts their money into fixed deposit after returns, once they pay their taxes, if they look at if they adjust it for inflation, their money would have never grown. It would have always degrown. Now if we look at, and fixed deposits, the time frame is right from less than 1 year or maybe 1 year to any other time frame. Less than 1 year, it's 100% below inflation. So when it comes to shares or equity, on a 5 to 10 year basis, the returns is always inflation adjusted. So inflation, more than inflation, adjusted to even taxes. So real returns is always positive. Why is it positive? A very simple and easy way to explain would be, can you think of any business which can buy at which would buy their get their product at a price? So let's say um, be it bread or milk or anything or any hard product or services, whenever we are deciding on the pricing at what price we are going to sell, that pricing will always include inflation and it will also include whatever expenses you are incurring. And that's how you will always have and probably on top of it, you will also have some profit. If you don't do this, if you don't add all of these things into your cost price, what is going to happen? You are always going to make a small loss, and you can't continue a business other than you can't do a business on a long term basis. Have you heard of any business which has been loss making for 10, 15, 20 years and it has still been around, or maybe longer than that? In my estimate, a business cannot make losses for more than 5 years. So unless maybe Paytm can be the sole exception that I can think of, which has always been in losses and it is still continuing and people are still very gung-ho about it. But if you remove that as an exception, I can't think of even a single business which has remained in loss or which has not made profit and is still going for more than 10 years, right? So shares basically makes you a partner into the business, and any business can only survive if it is uh, if it is able to make a profit. To be able to make a profit, you need to make returns more than the inflation. You have to be your real returns have to be positive, which is the only reason why shares as an asset class will always be an inflation positive returns. Now, if we come to gold being the fourth place where we can, actually, it was the third place where we can invest. I have mixed up these sequencing. So, gold, if we look at gold on a 5 to 10 year basis, it is always inflation adjusted. But there can be times or eras when it is giving positive returns and when it is giving negative returns. Today, if you ask most people, should you invest in gold? Everyone will say, "Ki, haha, you must invest in gold. See, it has given such fabulous returns in the last 1 year or maybe 2 years." But there was a time when gold has not made money, as recently as 2013 to 17 or 2012 to 17. So for about 5 years, gold did not give any returns. It was at the same price level. In fact, if you would have met anyone in 2018 and asked them which is the one investment class, which is the one asset class where you should not invest, many experts would have said gold is the place where you shouldn't invest. Okay, because it was at a very stagnant price and it did not go up for about 5 6 years. Historically, as much as I have tried finding out, I think there was one many decades and uh, centuries ago, there has been one time frame when in fact for about 10 years gold prices did not go anywhere, and in fact gold prices fell. So historically, if you look at it, my conclusion has been that gold prices are always inflation adjusted. It doesn't give you more returns or less returns than inflation. It just gives you at par inflation adjusted returns. The reason why we feel it is giving a higher return or a lower return is because of its recent track record. So because we only look at these data points from the last 1 year or 3 year or 5 year perspective, which is why our view or our understanding ends up being, okay, it's either a great asset or a not so great asset. Okay, that clears up the first four. Now comes your mutual fund. Uh, I haven't mentioned about mutual fund over here because before we get into what to expect in terms of for how long we should remain invested and what sort of post-tax returns we are looking at, this is dependent on, before we get into this, we need to understand what a mutual fund is. Just a second. So, sorry. Some of the most common questions that everybody will have is what is a mutual fund, how safe it is, what is the minimum investment, and what returns should I expect. If we look into it, uh, what is a mutual fund? A mutual fund is basically it's an investment vehicle. Okay. So just as sorry. So as we have got what does a vehicle do for us? It takes us from point A to point B, right? So are uh, if we want to move, let's say within within one city, so we may choose a bike or a car or some other smaller vehicle. But let's say if we have to travel between two cities, let's say from Bombay to Delhi or Hyderabad to Delhi, then we will not be using, most likely will not be using a car. We'll either end up using a train or a plane. That's the most efficient way of traveling. And similarly, if we are traveling to, let's say, Saudi Arabia or USA or wherever in the world, we may take a plane. We will not be driving, we will not be walking up to the place. But you can't take a plane and think of going from one area in your city to the other area. That just doesn't work, right? So vehicle's purpose is to take you from place one to place two. Similarly, a mutual fund's basic purpose is to hopefully take your money from whatever you have invested in it. It grows up to the next level and helps you increase money. Okay, how does it work? So like all of us over here, we are doing whatever we have to do. Like those of you who are working as an engineer, you have your own work. Someone who is a physician has to look at patients. Someone who is into teaching has to teach. uh, so we don't have time to go and figure out which is the best stock to invest, which is the best fund to invest, which is the best place to invest in real estate. And this is where what we can do, we can create an investment vehicle. All investors, we all of us, we come together, we pool our money, we give it to a professional fund manager, and we tell the fund manager that, look, this is your mandate is to go around, invest, and make money for us. And that and these are your limits. So let's say we can put up a limit saying that you should only invest in Sharia compliant stocks, or we can put up a limit saying that I would want you to only invest into stocks, or we can put up a limit and say I would only want you to put into fixed deposits, or we can go and put up a limit that you can go invest into gold only, or we can say कि ठीक है, you can invest into all of these asset classes to the best of your understanding. But what we are looking at is returns at the end of the day. So what sort of guidelines do we give? That's up to us. We can set some sort of a guideline or a parameter around which the fund manager has to invest, or the guy to whom we are giving all our pool money. And that guy goes, invests accordingly, generate returns, and whatever extra returns that gets generated, he gives it to us. And for all of this service, they charge us some amount. And this is typically how a mutual fund typically works. Just okay. Now, one of the things that we need to be very clear about is that in a mutual fund, how much returns to expect, that is dependent upon where the fund manager is investing and what his or her mandate is. If the mandate is to invest into equities, then we should expect equity kind of returns. If the mandate is to invest into debt, basically lend money to corporates, take interest from them, then the returns we should expect would be somewhere in line with uh, fixed deposit returns, right? You can't make equity type returns investing into fixed deposit. Doesn't that cannot happen. So or you can have a fund which basically invest only in gold, which effectively means its returns will be in line with whatever returns gold is giving. So your returns in mutual fund is always subject to how you can invest or where all you can invest. And uh, how safe, the second question is how safe is it? Okay. The it is absolutely safe from fraud or from from problems that may arise because someone may just take your money and run away. So those kind of problems will never happen with a mutual fund because of the way it is constructed and the way it is regulated. For example, in Bombay and Hyderabad and I think Bangalore, about 4 years ago, there was a gold scheme which some shop guy has come, wherein you had to go invest into gold and basically invest into his through his shop, basically invest into gold, and once he makes money, he'll give everybody, and then eventually that guy he ran off, and there was a lot of people lost their money, right? Uh, Something like that cannot happen in a mutual fund because of the way it is constructed, because of the way it is regulated. An easy way to understand is uh, we all go and put our money into the banks, and we all know that the banks are regulated by RBI, right? Similarly, all mutual funds or everything to do with mutual funds or shares or stocks or listed equity, they will they are all regulated by SEBI. Okay, so the way SEBI has said is, let's say tomorrow we have a very large corporate house or a very large company, ABC Limited. The ABC Limited wants to start a mutual fund. They cannot just go and buy a license. It doesn't work like that. They first need to go to SEBI, say that we would want to start a mutual fund company, and SEBI may have some like 10 different questions asking them ki, have you been into the have do you have any experience in dealing with financial products? What sort of management are you trying to hire? Who will be your experts? Who will be leading it? There'll be like 10 different questions, and then SEBI will say, "Ki, "ठीक है, you can start a company, but first go and form these two things." So what they will do is they will first go and form a mutual fund company, the one in the black, and then they will have to go and form a trustee company. Now, a trustee company is basically a trust. Okay, all professional trustee companies are regulated by SEBI. All mutual funds are regulated by SEBI. All custodians are regulated by SEBI. So all of these people effectively, for everything, they need to go to SEBI to seek permission. So SEBI knows what is happening or what is taking place in each of these segments or companies separately. So what SEBI says is that when you are forming your trustee company, you can only have professional trustees. You cannot have a professional trustee from your group company. So let's say ABC Limited is a large conglomerate or it has many different businesses, and it also has a professional trustee company. So SEBI says you cannot have ABC trustee as your trustee company. Rather, you should take someone else. It can be your one of the banking like ICICI, HDFC, SBI. Everybody has a professional trustee company. So they say you should have your professional trustee from one of these places. And then the second thing they do is they say the mutual fund company or the asset management company cannot have any they cannot hold anything in their own name. So everything is held in the name of the scheme. Whatever, let's say they launch an ABC large cap scheme. So basically, you are investing into large cap. I'll be explaining what a large cap is, what a small cap is, also going forward. So, what SEBI has done is it has designed in a way that different people have got control of different things, and none of these are related to each other. Which is why doing a fraud is very difficult because to do a fraud, one has to coordinate with too many people. So the probability of fraud being committed in a mutual fund is next to negligible. It's a hypothetically also it's a very difficult thing to do. One thing that can happen is that you have a very bad fund manager, or let's say he's a bad fund manager because they don't understand something or they make a mistake, and henceforth they did not invest into a profitable place and instead they end up making losses. So that is, so your money can go negative. You can lose out money if your fund manager makes a wrong decision, but that wrong decision will not be out of malice. It will most likely be because they weren't able to understand it, or they, whatever hypothesis they had at the time of investment, it did not work out. Okay, that's the most likely scenario. What can be the, okay, what was the third question? What, how safe it is? We have answered. What is the minimum investment amount? Acha, how safe it is? And it is because of this reason why you will always find that in every ad of a mutual fund, you always have it written that mutual funds are subject to market risk. Okay. And what is the minimum investment amount? Minimum investment amount is, you can start with maybe 5,000 rupees. In some cases, it can be 100 rupees. One will have to see what is there in each mutual fund. There is no set limit, but I haven't come across any mutual fund which says you have to invest more than 5,000 rupees in one time. If you are doing an SIP or something, then it's 500 rupees. How much returns should I expect? That also I have answered, that it depends upon where, what is the underlying or where your mutual fund is investing. What is the mandate of your mutual fund? If it is investing into stocks, it will have stocks kind of returns. If it is investing into if it is investing into debt, it will have debt kind of returns. If it is investing into gold, it will have gold kind of returns. So your returns is completely dependent upon what is the underlying. uh Often I have seen that, can mutual fund returns, or let's say can returns of any asset class be predicted? The most common thing that I have come across that people do is they will look at past performance, last 1 year, last 5 years, last 10 years, or last 25 years, and then they'll say, okay, based on this past performance, this is what we should expect. Or they will cherry pick performance. So when someone will come and try to missell you, they will say, "Arey, look at last 6 months returns, it has done so great. Or last 5 years returns, it has done so great." Personally, I don't think one can predict uh, the returns based on past performance or by cherry picking any period. One can put up a probability, basically put up a range of possible returns that can happen, that can come out based on what the inflation rate is, what is the interest rate, what are the global events, and what is the past performance in context. For example, uh, a rule of thumb is that if you want to guess what would be the approximate returns that you will get in equities, is that you should just take the average inflation for last 10 15 years, or the expected inflation that you see in the next 1 or 2 or 3 years, and the expected GDP growth. If your GDP, and you can just add these two and get your approximate number as to how much growth you can expect in equity. Or if you want to predict the fixed income returns, then you just need to predict what the interest rates, the RBI or the central bank interest rates will be 1 year or 2 years down the line or 6 months down the line, and how will the inflation be moving. If you can get a broad grip on these two, then maybe you can make some amount of prediction. It will not always be accurate. Sometimes you will miss it, but in most likelihood you will get the trajectory right, like whether you'll make a higher returns or lower returns or negative returns. That is completely, that can be guessed to some extent. Okay. Understanding SIP, everyone. So many times I hear people say that they think that SIP and mutual funds are two different things. The answer is no. Mutual fund is the investment vehicle. SIP is a process. A simpler way to explain this would be, think of the imagery of a wall. Okay, a wall is made up of various bricks, and you need to line up or each brick next to each other, and that's how a wall is created. So SIP is something similar. The you have a goal. You have a goal of, let's say, if you look at our previous example, if you recall of our previous example, your goal, let's say, is to save 1 crore rupees. And to save 1 crore rupees, you need to make some investment every month. So making that investment every month is your SIP. The full form of SIP is systematic investment plan. So SIP is basically putting money on regular interval in a fixed way in a certain fund. And another way of looking at it would be your banks have got RD, recurring deposit. If you go to a bank, many times your relationship manager would come to you and say, "Okay, sir, please do an RD of 5,000 rupees at the end of 12 months, or um, 12 months you will get 60,000 rupees, and plus whatever that interest is, some interest amount." You can think of SIPs being similar to an RD. So RD happens with a bank, SIP happens with a mutual fund. And uh, is this part clear, or is anyone confused about what an SIP is or what a mutual fund is? Okay, we'll stick to this.
Bhai, I want to ask one question. In SIP, am I
Uh-huh.
audible?
Yeah, yeah,
In
you are audible.
SIP, there are different scheme, like that we can invest in growth plan or some growth fund or something like that. So which one do
I
you suggest that?
so I will come to those terms as well. So those terms will be a little later. I'll come to your
Okay.
other terms as well. But so far, like, the concept of SIP, is that clear or not? Or do you still think that
Yes,
SIP is like a mutual fund?
it's clear. It's clear.
Okay, great. Okay. Uh, so broadly, if we look at it, what SEBI has done is SEBI has done a sort of a straight jacketing, where they have said that there can be only five types of mutual fund, broadly five types of mutual fund. You have an equity fund. Equity fund is defined as any fund which has 65% and more into equities at all points of time. Debt fund will be a fund which will have, okay, I have made an error. It's not 35%. It's basically all your 100% is into fixed income, is into debt. And hybrid is where you have equity and debt. So basically, it can be 65% into equity and 35% into debt, or it can be 50% equity or 50% into debt, and then maybe some other asset class, maybe gold or something. Okay. Then there is solutions, which is your children's plan and retirement plan. Within mutual fund, you will have sometimes you will come across these terms, and then there are others. So what comes in others is basically your fund of fund and your index funds or ETFs. So I'll take you roughly through all of these. Before this, we need to understand about classification of stocks. So before we get into this, what we'll do is, if you remember the example where we set up our own business, this one, everybody remembers this part, right? How we made into equity and debt and income and net profit. So let's take this story a little forward, because then it will be easier to understand. So let's say we start making this investment. No, sorry. Let's say this business starts making profit and it gives out some money. Okay, it adds up to the income. Now it this keeps happening, and let's say three of us are business partners into it, and suddenly one business partner comes one day and says, I would want to get out of the business. I would want to leave, right? So now the value of the business would have changed. The business has, let's say, grown to some large number. It's throwing up every year a huge amount of money, so on and so forth. So how do we help the partner, one of the partners who want to leave? Let's say Navid bhai and I and maybe Hafiz bhai are partners, right? And we have to decide कि ठीक है, uh, Navid bhai wants to leave, so he says कि I would want you guys to take up my shares. And then either you buy my shares, find myself some replacement, or do something. But I want to get out of the business. I want my money back, whatever I had invested into it. Okay. And we don't have any money. Matlab, Hafiz bhai and I, we don't have any money. So what do? We have to either find ourselves a third partner, or the second option that we have is we go to an exchange or we go to a mandi. सब्जी मंडी में क्या मिलता है? सब्जी मंडी में we find vegetables, right? So if we go to a car shop or a car ki mandi, what will we find? We will find whatever cars that are available over there. So similarly, uh, there is a mandi, or there is a place where all the shares are being sold. So everybody who owns a share, they can come and sell their shares uh, in that place. And what do people do? What people do is, you just can't enter into that place and say, okay, I have got some shares, please buy it. Rather, you will have to first go and figure out, okay, how do I sell through that mandi, okay, through that place. And and so there would be some process. So in India, there are two major places where all types of shares are being sold. One is the National Stock Exchange, NSC. The other is the Bombay Stock Exchange, BSC. These are the two main places where shares are sold. Now, to make it available so that people can buy and sell your shares, what do people have to do? They need to first go talk to one of these two places or with both of the exchanges and say, we would like our shares to be listed, that is to be made available. And they will say that, okay, you can do that, but there is a process. That process is called IPO, initial public offering. So you will keep hearing about IPO aa raha hai, IPO aa raha hai. There is an IPO coming of ABC company or a XYZ company. So each time they say that an IPO is coming, basically this used to be a private company, and now they would want to sell it or make it available on the stock exchange. Now there are two reasons why people come out to do IPOs. The first reason is that some people, which is always, and the reason for the IPO is always written in the document. If you read the documents that are made available at the time of IPO, you will find why they are raising it. So they need to mention it. Every company needs to mention it. So there are two possible reasons. Reason number one, some partner, like in our case, some partner would want to say, okay, I want to get out of the business. I want to exit the business. And the other partners don't have enough money to buy his shares. So they say, okay, ठीक है, we'll do an IPO and we'll get new set of partners and we'll make the company listed, and you can take your money and you can leave. The second reason is let's say we want to set up a new office in USA. So now we need more capital. We don't have the capital. Our choices are again the same. Either we need to put up equity or we can borrow it from someone. We don't want to borrow it from anyone. So if we don't want to borrow it from anyone, how do we do it? We need to get ourselves some partners. What's the one way of getting all these partners is, since the business is already in existence for more than 3 years or for more than 5 years, and we have our financial statement and everything is available, it is audited and available. Henceforth, we can approach the exchanges asking them to help us prepare for an IPO, because we need to raise money so that we can buy up an office space and probably pay off some initial salary to some people in USA or Europe or wherever, and then expand our businesses. So these are the two possible reasons, and you will always find it in the IPO documents. So our reason is basically our partner wants to leave. So we go to the exchange, we get it self listed. Once the listing happens, all the people who buy shares, they give money to the company pays, or the money gets basically is transferred to the partner who wants to leave. Okay, that's the purpose of a exchange. So in the Indian stock market, or in the Indian stock exchange, there are more than 6,000 companies which are listed. Okay, the price, the number of shares of a company, the total number of shares of the company into the price at which it is being made available in the stock exchange. If we multiply these two things, it becomes total market capitalization. Now, SEBI has defined for us that if we put up total market capitalization of all the companies that are available on BSE, NSE, and MCX, the three exchanges. So there are two major exchanges for stocks, which is BSE and NSE. We also have a third exchange called MCX, which is more famous for catering to commodity, but they also have got some companies available on their stock exchange. So the average market capitalization that is traded on that is available with all these three exchanges, the average of that is used, and then they are put in the descending order. So the 100 largest companies that are there, they are called large cap. The next set of companies is in that descending order is 101 to 250. That's about 150 companies. Those are called as mid cap. And after 250 companies, everything that is there, which is 251 companies onwards, they are all called as small cap. This list is always available in the public domain on the website of Amphi. Okay. So you can in fact do a Google search as market capitalization Amphi list, and probably the first, second, or third result will be one of the top three results will be an Amphi link, wherein you will find that, and this activity is done once in every 6 months. So on the 1st of Jan and on the 1st of July. So every time this activity is done, your list of top 100 companies, so large cap, mid cap, and small cap, gets changed twice a year. Why is this information important? Because then now you can understand the different type of funds that are there. So there is a large cap fund first, where the mandate is, the SEBI mandate says you should invest at least 80% into large cap stocks, the 20% the fund manager's prerogative. Wherever they think that one should invest, they will invest. Typically, what happens is fund managers invest even that 20% into large cap companies. Okay. The second is your mid cap companies, where at least 65% has to be invested into mid cap companies, the companies that are classified as mid cap, which is 101 to to 50. And then small cap, again 65% has to be invested at all points into small cap, and the rest 35 is up to the fund manager. They can invest into equity, they can invest into debt, they can invest into gold, whatever they would want to do. SEBI doesn't say anything. Usually the funds in their um, the funds in their presentation, they explain these points, and mostly your advisors will be able to find out how, or whatever they are recommending, how is it that these funds will actually be investing, or you can also check out their own presentation. Then comes multi-cap funds. In multi-cap funds, the logic is 25% has to be into large cap, 25% has to be into mid cap, 25% has to be into small cap. The rest 25% is the fund manager's prerogative between the three of them. Sorry, I missed the large and mid cap. So large and mid cap is also a fund category which says 35% has to be into large cap stocks, 35% into mid cap stocks, the rest of them into small cap. Okay. Then there is a fund called flexi caps fund type, which basically says that 65% has to be invested into 65% has to be invested into equities, and there is no limitation between large, mid, and small. You can invest anywhere, whatever the fund manager believes is the best places where they can invest. Then there are different types of funds. For example, there is a dividend yielding fund, which basically invests into stocks which has to give dividend on a regular basis. So 65% of the stocks have to be invested into companies which give out regular dividends. Then there is a value fund wherein 65% has to be invested, which is value investment strategy. Personally, I think flexi cap and value fund, there isn't much difference except for there are some technical differences, but that's not like a big difference per se, but they are very similar in nature. The differences is more because of the benchmark and so on. Then there is a contra fund, there is a focus fund. Focus fund can only invest into 30 stocks. They cannot have more than 30 stocks into their portfolio at any point of time. Then you have got sectoral and thematic funds. These are funds like there can be a theme. So Sharia compliant investing is a thematic fund. Okay. FMCG fund is a sectoral fund. Consumer fund investing only into consumer stock or a consumer theme fund is a theme. So you can think of many sectors put together can form a theme. A theme can be is usually a larger idea which can consist of various sectors. One of the examples of a theme can be your infrastructure is a theme. Now within infrastructure theme, you have got several sectors like cement is a sector, steel is a sector, iron is a sector. Infrastructure companies are a is a sector. So so thematic fund or sectoral funds, the limitation is, or you can say the bindation is that 80% of those investments should be into a particular sector and theme. Okay. Then comes your debt funds. So debt funds, like I've already said, how do they make money? They make money from one of two places. Their primary source of income is basically interest income. So they have lent money to someone. Against their lending, they are going to receive interest. And the second place where they earn is when the price of these when the when interest rate falls, you end up making some extra money, because let me explain it to you in this way. It's much more easier to understand. Let's say you went to do an FD, okay, or your and from that FD is giving, let's say, 8% fixed interest. Out of that 8% fixed interest, what happens is uh, 2 days after that, RBI comes up and says, okay, we are slashing down interest rate. No more, no more interest rate has to come down. So because of the RBI's stance, the bank also reduces its FD rates. So from 8% it goes to 7% or 6%. Now you have an FD which is giving you 8%. But if someone goes today, then they will only be getting a 7% FD. So basically you are making 1% more. So if you try and, while it's very difficult, but let's assume that there was a market which says that you can even sell your FD, then your FD cannot be sold at the same price as today's FD. It will get a slightly higher price because you are getting what you are selling is basically a higher interest rate paper, and because of which you make an extra capital gains. So similarly, the reverse also takes place. Let's say you go and do an FD today, and tomorrow the interest rate rises. So after tomorrow, if you go to sell out your FD paper, nobody is going to pay you the full amount, because if they just go to the bank, they will get a higher interest rate. So why should they buy from you that FD paper? And which is why, while everybody says that or thinks that in debt funds you cannot make negative returns, it is not true. There is at least one scenario where you will make negative returns if the interest rate goes up. Okay. So, and what kind of risk does it carry? It carries default risk and interest rate risk. Interest rate risk is the same thing. If the interest rate goes up, the value of your FD or your debt investment goes down and you make a loss, and which is very important to understand. Default risk, let's say you give your money to some bank, you may have come across several stories which says that cooperative banks shut down, all FD has been lost, and similar stories. So this is also the second reality with debt investment or debt based investments. So all debt based investments carry these two things: default risk and an interest rate risk. And which is why even debt funds or debt investments can give negative returns for some period. Why do people invest in it? Because it brings diversification. When your equity is falling, most likely your debt will not be falling, and whenever your equity is rising, most likely your debt is at the same level, or something can happen over there as well. So basically it gives people a better, uh, it reduces the up and down or the volatility. So volatility is a technical term. The the change in your portfolio that happens when you are only investing into equity can be extreme. It can go up 10, 15, 20% in 1 year, and then it can go down also by the same level. So that doesn't happen when people are investing into debt fund. Now comes what are hybrid funds. So there are six types of hybrid funds only. There is one hybrid fund which is called arbitrage fund, wherein all your investments, or rather, all your equity investment is fully hedged. What is the meaning of being hedged? Whatever you have invested into equity, you buy a type of an insurance, or you buy a type of an insurance on it, and henceforth, what happens is, even if the equity markets fall, you don't make a loss. So how does the fund make money? Because only 65% has to be invested into equity, correct? If you remember the previous slide. 65% has to be invested for equity taxation and for a fund to be classified as equity, right? So in this case, what happens is 65% is into equity, and on that 65%, transaction is made where derivatives are bought, and basically it is well protected. Now, whether the prices go up or prices go down, irrespective, the fund will not see any change. And out of the 30% that is available, they will make some amount of money. Within equity, the only place where they will make money through arbitrage is because of price differential. So let me give you one example of arbitrage. So let's say we have that stock ABC. ABC stock is available on BSC for 100 rupees, and on NSC it is available for 105 rupees. So you can buy the stock at BSC and sell it on NSC, and you will make 5 rupees profit. This is an arbitrage opportunity. Another way in which arbitrage opportunities come is, let's say you buy you buy a stock, and then there is some price differential in futures or in the derivative market, and you use that for offsetting, or you can use that gap to generate extra returns, and this is called as arbitrage fund. But most often nowadays we don't find as many arbitrage opportunities, which is why in arbitrage fund, the other thing that fund managers do is that they basically just hedge the portfolio, basically buy a type of an insurance, or they set up a trade in a way between stocks and derivatives, that irrespective of whatever happens in the market, the stock price does not move, or it moves negligible, less than 1% movement will take place, which is very, very small. So this is a arbitrage fund. A conservative hybrid fund will be a fund which will have 75% into debt and 25% into equity. An equity savings fund will be a fund which will have around it will have 65% into equity, then it will hedge around 15 to 50% of the equity. So let's say 65%, out of which 15% gets hedged effectively, only 50% is available into equity market. So whatever happens in the stock market, only for 50% of the portfolio there will be some impact. And the last 35% is put into debt, wherein the fund is receiving interest rate. Why this instrument was created? This was created because it gives you some equity participation, but at the same time it reduces volatility, because overall it's not available, not a lot of money is into equity savings. So think of it in this way. Let's say you have 10 lakh rupees, and you need this money is required in about 1.5 years, and you are willing to take some level of risk. So what do you do? So if you go to a regular, in general, if you go to most of the advisors, they may say, "Okay, okay, out of that 10 lakh rupees, you can do one thing. You can put 2 lakh rupees, which is 20% into equity. The rest of the 80% you can put into a debt fund. So from the debt fund, you are getting fixed interest on that 20%. Even if you make 20% loss, you will still get back the rest of the money. So out of 20 lakh rupees, even if you make a 20% loss, that's around 40,000 rupees. So 1 lakh 60,000 or 1 lakh 50,000 you will get back, and you will be making on the 8 lakhs that you have invested into on the debt side, you will make some money from there. So on average, you will not lose a lot of money. The best case scenario, this is your worst case scenario. Your best case scenario is that 2 lakh rupees into equity, in 1 year's time, something happens and you make a lot of money. That 2 lakhs becomes maybe 4 lakh rupees or 3 lakh rupees, or some other amount. Okay, some higher number. So what will happen because of this? This will result in this will result in in your portfolio getting a very good returns and your money increasing, and henceforth your goals will be fulfilled with ease. So you have taken a very small risk, but you have some probability of making higher returns. So instead of doing it with two different instruments, you can just put the money into equity savings fund. This so in our example, what we did, we put money uh, into equity fund separately and debt fund separately. In this case, you can just put the money into equity savings fund, and the fund manager itself takes care of this entire portion. You just need to understand whether you want a fund which has net equity of only 20%, or whether you want a fund which has a higher level of equity participation, that's 50%. Okay, the fourth type of fund is your balance advantage fund or dynamic asset allocation fund. Basically, this is a fund where the fund manager has absolute freedom to invest between equity, debt, and arbitrage the way they believe that they should invest. Most likely, most of the mutual fund companies will have some sort of a model by which it will be dictated. So, uh, and then you have got aggressive hybrid funds. These are funds which will basically be investing uh, 65% between 65 and 80% into equity, and the rest will be into debt at all points of time. So you invest if tomorrow the market increases and their debt holding reduces, so what they will do is they will move some money from debt into equity and then rebalance it again to the whatever the stated level that they have to maintain, that is between 65 and 80% into equity. And then comes your multi-asset allocation fund. These funds invest into equity, debt, and gold, or it can be equity, debt, gold, and real estate. It can be equity, debt, gold, real estate, and maybe some foreign stocks. So there are many different forms and format of multi-asset allocation funds. So so multi-asset allocation funds will give you various there are many permutation and combination. Okay. Then comes your ETFs and index funds. This is another common query or something that people would want to always understand. So what are exchange traded funds? Exchange traded funds are those mutual funds which are available on the stock exchange. To invest in them, you need to have a demat account, and you can buy and sell them only on the stock exchange. It is not available through a mutual fund company. Okay. Uh, what's the Whereas an index fund does not require a demat account, you can straight away go to approach your advisor, or you can approach the mutual fund company and buy the index fund. Where does an index fund and ETF invest, exchange traded fund? They both they both follow a benchmark index. So the natural question would be, what is a benchmark? So think about it in this way. We have already seen that there are 6,000 listed companies on the stock market. So if we have to make a guess if the market is doing well or if it's doing bad, what do we do? Do we go around and look at the prices for all 6,000 companies? That will become a very tedious task. While today we have all the technology in the world based on which we can probably do it with ease, but doing this maybe 10 years back or 15 years back or 20 years back was not an easy task. Therefore, what people did was we created we created an index. What is an index? An index is basically, in a book, if you look at the index, what does it tell you? It tells you what are the different topics that gets covered. It tells you on which page number you will find which topic. It tells you a broad uh, idea about what is there and what is not there in the book. Similarly, an index in the on the stock market basically tells you how that part of the market is. So often you will hear Nifty 50. What is Nifty 50? Nifty 50 is an index of 50 companies. What are these 50 companies? These 50 companies are the among the top 100 companies. The 50 largest companies are taken, and they are ranked in a certain way where each company gets a certain weightage, and based on those weightage, when that when that index is created, each time there is a movement in one of the companies, the index will also have some movement. So let's take the example of Nifty 50 today. If we talk about Nifty 50 today, we will have probably Reliance Industries, maybe one of the Adani companies, and then TCS and Infosys, and so on and so forth. There will be some 50 companies in there. So each time Reliance Industries have a movement of maybe 5 rupees, 10 rupees, 100 rupees, whatever. So that movement corresponds based on the weightage that RIL will have in Nifty 50. Nifty 50 will also move accordingly. So let's say if 10% is the weightage for RIL in Nifty 50, so whatever movement happens in the RIL, that will impact Nifty 50 by about 10%. So there will be a 10%. Um, so there will be so out of that entire 100%, 10% will see some movement. So similarly, if you go by each company, all of them put together, they will have some movement, and which by the end of the day is what we get to see. Acha, Nifty 50 moved by 2000 points or 200 points or maybe 1 percentage point or 2 percentage point. And that's what Nifty 50 is an index which shows us how the top 50 stocks they are performing. It gives us a sense of how they are performing. And a a fund strategy which is investing in only into large cap should ideally have a benchmark of Nifty 50 because that will be more appropriate. So similarly, one can create a Nifty 50 ETF, which effectively means that whatever is the composition of Nifty 50, that is exactly what your ETF will also do. It will, if there are 50 stocks of in a certain proportion, in the same proportion, even ETF will buy. In the same proportion, even your index fund will invest. So what is an ETF and an index fund? It basically follows the benchmark completely, and it does not require a fund manager. It is basically a way of investing in which the fund manager is irrelevant. It's the index that becomes relevant. If the index does well, your portfolio will do very well. If the index is not doing well, your portfolio will not do well. So if your index creating criteria is not very good, then your returns will also not be very good or otherwise. So there is globally, if we look at, so this type of investing is called passive investment. Okay. Passive investment is when you are not investing by when you are not choosing which stock to buy and how much to buy, but rather you are just mimicking or following an index. Why is passive investment of late you will come across many articles, many places where you will find that one should be investing into passive funds. Okay, we'll try and end this as soon as possible. I've already increased time by 10 by 10 minutes. So, uh, passive funds have become a very important place for investing because in US there has been a lot of studies which says that uh, passive funds tend to outperform active funds over the long term, and this notion has also percolated in different countries. Okay. This notion is not 100% valid in the case of India. It will happen probably over 1 year or 2 year or 3 year, but in India, I think active funds still more have better uh, has a better option, or it's a better place to invest for many investors. Okay. Why do I say that? Because in US the expense is very high. So the charges that mutual fund companies charge to their investors for managing the entire money is very high in an active fund, and it is very low in a passive fund. Okay. And this is the reason why in US your charges is somewhere around 2 to 3%, 5, and I have seen charges up to 5% if I recall correct. So 3% charges is not like a big deal, 2 to 3% charge. Whereas in India we don't have that level of charge. In India, the way things work is as your fund size becomes larger and larger, your expense ratios has to be brought down. So which is why there is certain edge in my perspective with active funds compared to ETF and index funds. Benchmark is done. Okay, these are some other terminologies that come in handy, or that many of you would want to know. What is a direct fund? What is a regular fund? What is KYC, nominee, asset allocation, bank mandate? So direct fund and regular fund is basically, so any fund where investors invest today, any mutual fund where you invest today, you will have a direct and a regular plan. What does direct plan and regular plan showcase? Direct plan and regular plan, the difference between the two is basically the commission that is being paid to your mutual fund distributor. So if you go through a mutual fund distributor, you will always be given regular fund. The mutual fund distributor cannot charge you any fees for their services to the investor. And if you go through an investment advisor, they will charge you a fees, and they'll always give you a direct fund, because nobody will do anything for you for free, right? So the distributors are to be paid, but they are only paid through commission, and that commission amount is what is the additional amount that one has to uh, pay or give when they are investing through they are investing that gets reduced when you are investing through direct funds. So direct fund is for those investors who are well informed, can take their own decision, or are taking advice from a financial advisor and paying them a fees. Okay, so an investment advisor will only be recommending a direct fund, whereas anyone who is making money from commissions will be offering you regular funds, and they will not be charging you anything extra. So what is KYC? KYC is know your customer. It is a mandatory whenever you will start investing, you will find that every organization does a KYC, whether be it your mutual fund company, be it your bank, be it your stockbroker, they all do KYCs. They all have got separate KYC. So with each one of them, you will have to do a KYC. So in the mutual fund industry, there is a standard KYC. So if you do KYC once, it's applicable to all the mutual fund companies. Um, with brokers, I think they have got separate KYC for each one. So you'll have to do KYC with each broker with whom you register yourself. and same goes with the bank. You will have to do a separate KYC each time you go to the bank. They will ask you tons of questions. Many of those will seem as irrelevant, and we may not understand why it is even required. But then, okay, those are regulatory requirements, so there is no way around it. Whatever information they would ask, we will have to inform them. The very important thing that has become now in the mutual fund industry is nominee. Earlier it was not compulsory, so one can make investment without choosing a nominee, but now you have to give a nominee's name and also a nominee's information, which is very good, because if anything happens to us, then our nominee can at least get the investment. It makes it easier for transmission of money. Another term you will come across is your asset allocation. So asset allocation is basically how much you would want to invest into equity, how much you would want to invest into gold, how much you should invest into debt, and so on. Is asset allocation, um, there is a paper which is often highly quoted, which basically says 90% of your returns come through asset allocation and only 10% comes from security selection. So you can make a lot of money by uh, by by choosing just the right asset class, or by having the right asset allocation, and you can lose, uh, or you can say you can make less money because your asset allocation was not right. Uh, what's the other term that I often hear many people get confused about is bank mandate. So whenever you are investing into a mutual fund, or maybe when you are investing through a bank, you will come across this as bank mandate. Think of bank mandate as a permission limit. So for example, your debit card has a limit of 1 lakh rupees or 2 lakh rupees of withdrawal every day and shopping, right? But we don't go and spend that much. We mostly will be spending what, 100 rupees, 500 rupees, 1000 rupees, 10,000 rupees. So bank mandate basically sets a permission limit. So just like your ATM has a permission limit of 1 lakh or 2 lakh rupees, your bank mandate can also will also have a permission limit of whatever you would allow your advisor to set in. And but how much of it is used is a different issue that we will that you can always decide later. So I think for today we will end over here, and next Sunday we'll probably sharply at start sharp at 10:30, and then we'll complete the rest of it. The so second session will mostly be about Islamic finance. I wanted to clear up everything on this part. What I'll also do is I am sharing a link. It's basically a form. Please save this form with you. Any questions that you have throughout this week, just keep adding to it or sending me. And then next session when we will start, I'll answer and take you through, uh, give all the answers, and then probably start up with the presentation. Or if I think that whatever questions you have, we'll be addressing it going forward in the session itself, then accordingly I'll inform you and then probably change it. So just to make it easier, please save this form, and I think inshallah we'll see you next weekend. My humble request would be that let's start at 12:30, because otherwise Zohar time is around 1. We will not have enough time to finish or even do a proper Q&A.
Inshallah. Jazakallah khairan kasira. So as we have come to the end of this first session of our series on Sharia compliance, on behalf of PSF, I would like to express our heartfelt thanks to our speaker for sharing such a valuable insight on how investment can be aligned with the principle of Sharia. I would also like to extend my sincere appreciation to the entire team working behind the scene to ensure smooth execution of this series. And finally, to our participants, thank you all for your active participation and genuine interest in learning. May Allah subhanahu wa ta'ala bless us all with halal sustenance, barakat in our wealth and health, and success in our financial and spiritual journey. So, important announcement for our upcoming session. So, as you all know, our next session in this insightful series will take place on Sunday, that is July 27. In this upcoming session, Mr. Shoaib Zaman will continue to guide us further into the world of Sharia compliance, offering deeper insight and practical strategies to align our financial goal with Islamic principle. So I would conclude by saying a few couplets. रिस्क का है वादा खुदा के करम से रिस्क का है वादा खुदा के करम से राहत सिर्फ है हलाल के हर कदम से वाखिरुद्दावाना अनिल हम्दुलिल्लाहि रब्बिल आलमीन जज़ाकल्लाह खैरन कसीरा एवरीवन Jazakallah Nilofer, you are there. Jazakallah
Yes,
Nilofer,
Bachi, yes.
yeah, Jazakallah.